Welcome to Accounting Principles 1, Principles and Assumptions. Today we're going to talk about the 4 accounting principles: the cost principle, the revenue recognition principle, the matching principle, and the full disclosure principle. Our first principle is the cost principle. This principle dictates that accounting information is based on actual cost, and cost is measured on a cash basis or a cash value basis. So for example, if you purchase a $1,500 computer on sale for only $900 to use in your business, the value of that computer on your balance sheet would be only $900 because that is the actual cost that you paid for the computer. Additionally, if you purchase a vehicle listed at $8,000 for your business, but you traded some equipment with a cash value of $6,000, then the vehicle would be valued on the balance sheet as $6,000 because that is the actual cost that you paid for the vehicle. Our next principle is the revenue recognition principle. This principle determines when revenue should be recognized or recorded. The general rule is that revenue is recognized when earned, and typically revenue is earned when services are rendered or goods are transferred. Revenue is equal to the cash received plus any cash value of additional items which might be received for the goods or services. So if you sell some goods for cash plus some other item that is traded, then the value of the cash plus the cash value of that item would be equal to the revenue received for the item. Our third principle is the matching principle. This is sometimes called the expense recognition principle. This principle requires that expenses be recorded in the same accounting period as the related revenue. So let's think about an example. During the holidays, retail stores typically hire extra staff to handle all the extra sales and activities related to the additional holiday sales. However, the paycheck for some of this work is actually received in January. January is not when the sales were actually made. The related sales revenue for these expenses in December. So therefore, the expenses for the paycheck should be recorded in December rather than January, when the pay is actually received by the employees. Our last principle is a full disclosure principle, and this requires that companies include all material transactions in their financial statements. Now, materiality is company dependent. For a small business, a transaction of $100 or $1,000 could be considered material. But in a multinational company, on the other hand, that amount might be as high as $50,000 to $100,000. To determine materiality, think about any transaction which would impact the decision of a user using that financial statement, regardless of the amount. For example, a pending lawsuit could be considered material even if no settlement has yet been reached, and there is no monetary value to that lawsuit. But if an investor was reading a financial statement and saw a note about a pending lawsuit, then that could change their mind about whether or not they wanted to invest in that company. We'll now move on to the accounting assumptions. The 3 accounting assumptions are the going concern assumption, the monetary unit assumption, and the business entity assumption. The going concern assumption is the expectations that consumers have that a business will remain in operation for the foreseeable future. So when you go to a store and you buy an item, you have an expectation that if there's a problem with that item, you'll be able to return it to the store for either a refund or exchange for a new item. Unless you see a going out of business sign, then you expect that the business that you're conducting a transaction with is going to be in operation in the future. Our next assumption is the monetary unit assumption. The monetary unit assumption assumes that all transactions on a financial statement can be expressed in monetary terms. In the United States, the monetary unit is dollars. The final assumption is the business entity assumption. This requires that all your business transactions remain separate from the transactions of the owner and from any other business the owner might own. A business owner should always keep the business transactions separate and not pay personal expenses with a business expense funds, and vice versa. When you go to the grocery store, you shouldn't be buying your groceries with business funds, and you shouldn't be paying your telephone bill for the business with personal funds. Each entity, meaning the business, the owner, and any other business the owner might own, all need to stay separate.